Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. Normally you'll hear Bryce introduce the show, but today I am your host, Ren, and I'm joined by a special guest host because we felt we had to jump into the studio and talk about what's going on. Simon, welcome to Equity Mates.
Yes, hello Ren, how are you doing?
I'm good. Now, Simo, you've been on the podcast before a couple of times, but for people who haven't heard your voice before, who are you?
Yeah, so Simon, been in the Equity Mates team for a couple of years. Been on the podcast a couple of times recently, missed the Beat Up segment. So if anyone hasn't heard that, check it out. So great to be here.
At our live show, a lot of people talking about Mr. Beat Up, your call on Tesla earlier this year. But we're not here to talk about that because there's so much happening in markets. Now, Bryce is overseas. He's picked a great time to head off and hopefully he's turned his phone off and isn't following along.
Markets have gone wild.
I know, but we've been watching this the last couple of days and we thought we had to jump in and talk about it. So on today's episode, we're going to be covering all of the news that's happening in markets, both in Australia, in the US and in Japan. A big news segment to kick it off. We'll also talk about the RBA. Then we're going to talk about the news that came out of Berkshire Hathaway, Warren Buffett's company. They are now sitting on $250 billion of cash.
Wow.
So we'll talk about what's happened there and what might happen next. I've got a theory that I'm going to float that I haven't seen in...
Looking forward to hearing this.
Yeah. But Simo, let's start with the news. It's time to hit that sting.
News and markets.
So where do we want to start?
RBA decision.
RBA.
It's just happened, hot off the press.
Yeah, let's timestamp this episode. So we're recording Tuesday afternoon. So this episode will get released Thursday morning, and who knows what's going to happen in the next 36 hours. So the RBA, they now meet every 6 weeks, the Reserve Bank, to decide the cash rate. They've just released their minutes. What have they told us?
Well, they've held. As expected, anticlimactic, probably what everyone was saying was going to happen. They've gone with the big flat hold.
Okay. Yeah, quite anticlimactic.
It was, yeah. I mean, I think a few weeks ago, maybe it was starting to decide there could be a raise, but then the inflation data came out a couple of weeks ago saying it was kind of moving sideways, slightly going down, and I think that kind of tempered the enthusiasm for a raise.
So for context, in May, inflation was 3.6% in the 12 months to May. Then it ticked up in June to 4% in the 12 months to June, and then it ticked down to 3.8% in the 12 months to July. Now, importantly, that's not within the RBA's target band of 2 to 3%, but it was sort of as projected. And so when the Bureau of Statistics released that inflation data last week, everyone kind of thought, okay, the RBA are probably going to hold. So this wasn't really a surprise. I think everyone is confident the next move is down. But if inflation remains... above that 3% consistently, they're going to be forced to raise again at some point.
Yeah.
So that's thought number one. Don't think that the next move is definitely down in Australia. But point number two is overseas, the next move is definitely down.
Like starting to be down.
Yeah, Bank of England.
Bank of England, yeah. And European Central Bank and Canada.
Oh, really? Canada did as well.
Yeah.
And then the US is all but guaranteed for one rate cut in September, and the talk is now, will they do one or two? And it means that Australia is going to be out of step with the rest of the world.
Yeah, well, it really feels like the RBA have tied their own hands. And obviously hindsight's a wonderful thing, but it feels like by not raising interest rates earlier, they're now in a really sticky position. Inflation's moving sideways. They can't raise rates, though, because in Australia, we're actually in a per capita recession. Obviously, we're not in a defined economic recessions of 2 negative quarters of economic growth. But if you take out the population growth, we're actually in a recession on a per capita basis. So ideally, the RBA would be looking to follow some of these other countries around the world and start talking about cuts. And that's what a lot of people want. But as you just explained, they can't really do that until inflation's in this target band.
Yeah, and if they were to raise while the rest of the world is cutting, that would appreciate our currency, which wouldn't be good for exporters and the like. But look, there's a lot going on with the RBA, and I think there's a lot more to be said. But the news of the day is they've held rates. Good news for mortgage holders. A lot of questions still remain about where Australia sits with the rest of the world. But I think we should move on, because the biggest financial story of the past week has been what's going on in the share market in Australia, in the US, in Japan, around the world.
Yeah, Bryce has been away, 2 weeks? A lot's changed since then. I think barely a fortnight ago, stock markets were seemingly on this unstoppable bull run after months of hitting all-time highs. And now they're, well, I was going to say in free fall, but they've actually bounced back a bit today.
Yeah. We'll get to that. So I think the story starts in America, and it starts with their jobs report and unemployment news late last week. Unemployment ticked up to 4.3%, and they added new jobs, but not as many. The number of new job openings was down. It was like 114,000, 140,000, something like that.
114, yeah.
And down from like 170 or something the month or the quarter before. So like, didn't seem catastrophic, but God, the markets reacted poorly to it.
It triggered something called the SARM rule. So I hadn't heard of this before. Had you heard of this?
No. SAHM for those playing along at home. SARM rule.
SARM rule. So it's actually named after an American economist, Claudius Sarm, and it's the rule basically says if the average unemployment rate over a quarter is 0.5% higher than the lowest level over the past 12 months, then the country is the beginning of a recession. And now, with that latest jobs report, it's hit that definition. Interestingly, Miss Sarm actually went on CNBC on Monday, and she actually said, we're not in a recession now, but momentum is heading that way. But she did add that in the US, a recession is not inevitable because they've got substantial scope to reduce their interest rates.
It kind of sounds like a yield curve inversion. It always indicates a recession, except for when it doesn't. So look, I think US recession probably likely. US per capita recession probably already in it. Similar story in Australia. We're in a per capita recession. Full recession probably quite likely. It's not surprising. Like, we're all feeling the pinch of higher rates, of cost of living, of sustained inflation. But the stock market has been amazingly resilient. The stock market seems to have been able to shake off any economic bad news, slap AI on an earnings report or a press release and see your stock price rise. The share market has just been a star performer in a sea of pretty bad economic news, but that kind of changed pretty sharply at the back end of last week. Here in Australia, on Friday, the ASX 200 was down 2.1%. It was the worst day in 18 months. And then on Monday, it was followed up by being down 3.7%. In total, across those 2 days, we were down 5.6%, which was the worst 2-day drop in 2 years. Thank God the financial press panicked.
They did, yeah, they did. There was something you put out on the daily email today from Scott Phillips, which our friend of the show, Scott Phillips from Motley Fool, which I really liked, which basically put it in perspective, I think, which I'll just read it out. So the US recession thing, it might happen. They happen pretty regularly. They're not desirable or pretty or welcome or painless, but they happen. And despite many, many recessions over the past 120 odd years, the Australian share market has averaged a gain of around 9% per annum over that time frame. Don't get me wrong, I'd love my shares to go up every day in a straight line forever. We all would, but we don't get that option. I started investing in 96 or 97. I've seen and invested through recessions, crashes, geopolitical crises, and currency collapses. They get easier, but they always hurt. No one likes to see their portfolios fall. The key, I disconnect my emotions from my actions. During the dot-com bust, I bought shares. During the GFC, I bought shares. During the COVID crash, I bought shares.
I think that sums it up. I think that sums up the message that we want to get across, that it feels like the sky is falling if you flick on, like I flicked on ABC News, like not a clickbait merchant by any stretch of the imagination, but it was, they moved finance up the bulletin. There was
Alan
panic
Kohler had a
in
big
Alan
slot
Kohler's
last night.
eyes. Like it was just, and it incentivizes all of the worst behaviors. And, we've been putting stuff on our Instagram. That's the ABC, but like, news.com.au and some of these other publications, like the race to get clicks, the panic clicks, the fear clicks are just so high. So this is our message to you. It may get worse, but stay the course. Your future self will thank you. I've got some numbers here from Morgan Housel. Now, these are US market numbers, but the same principles apply. He's looked back at the US stock market from 1928.
Okay.
Pretty big data set. On average, the US market falls 10% every 11 months. It falls 15% every 24 months. It falls 20% every 4 years.
Wow.
These market falls are a feature, not a bug. Like they're not something to be scared about. They suck, but they're just a fact of life. You don't get the Aussie market was up close to 10% this year. The US market was up over 20%. You don't get that growth without pullbacks. And I think last week summed it up so well. So Friday last week, worst day in 18 months. And that was the reporting. Friday, worst day in 18 months. Panic, panic, panic. First of all, the Aussie stock market was still up 0.3% for the week. Secondly, Wednesday was our best day in like 18 months in terms of like growth up. And Thursday, we hit an all-time high. And it's just like, just keep perspective.
Absolutely. And I think something else just to add is if you're a long-term investor, which I imagine the large proportion of people listening are, if you're looking at that 7+ time horizon, you should actually be welcoming a bear market, you could argue, because it doesn't feel like at the time, but that is where you actually create a lot of wealth because you're buying in, if you're dollar cost averaging, you're buying in at lower prices. And when the stock market recovers and rebounds, which it eventually will, you've actually made quite a large percentage gain on those times when you've been in the bear market.
Even if you're not dollar cost averaging, like the opportunities that are getting thrown up now are pretty interesting. One that caught our eye this morning, Ordinate, down like
35%
in a day.
Wow.
Yeah. And obviously they came out with some weaker guidance, but that's been a very hot stock that a lot of people have been watching for a while. So
yeah, that's right. If there's stocks on your watch list that you think are great companies, got great long-term potential, now is the chance potentially to start doing that DD. I think the Mr. Beat Up segment could be getting quite busy if this run continues for a few more months.
The whole market might be. All right, I think final word on the ASX. We want you to remain positive. We want you to remain thinking long-term. Things could get worse before they get better, but just remember that once you zoom out, things look good, and this is not unusual.
Yeah, well said.
But that's not all that's been happening in markets. Let's go overseas. Where do you want to go next, Japan or the US?
Oh, let's skip around Japan quickly. That's been making a lot of headlines.
Yeah, I feel like the scale of what's happening in Japan has somewhat been neglected because of what else has been going on. So what's happened?
Okay. Well, if we start with the share market movement, the Nikkei 225, which is the top index in Japan, worst day since 1987 on Monday, yesterday, down I think 12 to 13%. Today, at time of recording, back up 10% in a day.
Yeah, crazy.
What a roller coaster.
No, unbelievable.
But beneath that, there's been some other driving forces around the currency and people talking about the carry trade, which was another new term that I've learned this week.
So at a very high level, global investors have seen that interest rates in Japan have been lower. So they've gone and borrowed yen and then used that yen to buy assets around the world. With the theory being you only need a lower rate of return if you're borrowing costs are less.
Yeah.
Unfortunately for those global investors, as asset prices have fallen, just as Japan have raised interest rates and the yen has appreciated, and all of a sudden the assets that are buying in are worth less and their repayments are going up. because they've got to repay back in yen.
Yeah, that's my understanding. So they're now having to unwind a lot of trades to just make themselves whole again or get out of these positions, which is driving pressure on equity markets as well.
My takeaway from this is that like this is more a short-term market movement because of everything else that's going on, and less like long-term structural. It'll have repercussions for us in the same way that like what's happening in the US will.
Yeah, hopefully we see it. Hopefully we see it play out like that. Yeah.
So, with that said, let's jump across to the US.
Yes. NASDAQ.
Yeah, it's mainly been tech, hasn't it?
Yes, so I think we saw last week the S&P 500 fell about 2.4%, but the NASDAQ fell 3.8%. And I looked again before recording, the NASDAQ is now down 11.7% over last month, S&P 500 6.8%. So it's being driven by those big tech companies, and I think one of the main reasons is that investors haven't been that impressed by the quarterly results this quarter of the big tech.
Yeah, all the big tech are still growing. It's just that they have grown so much, their share prices have grown so much that there was a lot of expectation built into these results, and some of those results were a bit softer than expected, some were better than expected, but mainly across the board we've seen share prices fall. So Alphabet was down 5% over the last 5 days, Microsoft down 8%, Nvidia down 10%, Amazon down 13%, and Apple down 5%.
And below that, there's also been a bit of, I guess, pressure or news coming through that overnight Alphabet, a judge in the US ruled that their online search monopoly is illegal. We also saw Nvidia being hit with an antitrust case. And just generally, there's been a bit of kind of negative sentiment. And people, I think, to be fair, you've called this for a while, Ren, the AI hype bubble. It seems like investors are starting to see through that. There's been huge spending. Where are the results going to start coming through? That's what people are asking.
So I saw a real life example of, well, I read about, I didn't see it in person. Here, how do you like this for an AI use case? Yum Foods, which owns like Taco Bell, Pizza Hut, KFC over in the States, they're now doing AI drive-through at Taco Bell.
Okay, how does that work?
So rather than a human taking your order, it's going to be an AI taking your order.
Okay.
That's a use case.
Just like a voice recognition.
I guess so, yeah.
Okay.
Not bad.
That's good. Yeah.
How much value does that create?
Yeah, quite a bit of, labour costs are one of the highest costs, I imagine, for Taco Bell, so not bad.
But look, I think the big tech story, they fell, but let's just, again, zoom out and keep some perspective here. Year to date, Alphabet up 15%, Microsoft up 7%, Nvidia up over 100%,
wow.
Amazon up 7%, Apple up 13%. All of these companies are still growing. They're all still profitable. They're all massive in their own right. The story of them for the past 15 years has been super capital light with high operating leverage. So each incremental dollar of revenue they make, a lot of it flows to the bottom line. Whereas now that whole capital light story is starting to change because of their investments in AI. Like they're all spending, double digits percentage more each quarter than they were. But the overall narrative doesn't change.
Zoom out.
I think that's the story with a lot of this stuff. Like, if I was an investor in some of these big tech companies, I wouldn't be super worried. I'd be watching, but I wouldn't be worried.
Okay, but there is one stock in particular that I think we need to go into a bit more. Apple and our friend Mr. Warren Buffett.
Yes, let's do it. But after a quick break to hear from our sponsors. Welcome back to Equity Mates. Today we are talking everything that is going on in markets because it seems like, there's a month's worth of news in a week. I'm not joined by Bryce because he is currently overseas, hopefully...
Missing all this fun.
Not paying attention to what's going on. But I'm joined by Simon, who works here at Equity Mates, Mr. Beat Up. You might have heard him on the podcast before. We've spoken about what's happened in the US, in Australia, with the RBA, but we wanted to carve out some time to talk about what's happening with history's greatest investor, Warren Buffett, and his $250 billion pile of cash.
Wow, that's a lot of cash.
Yeah.
So Buffett, Berkshire Hathaway, they sold $50 billion worth of Apple stock in the past quarter. that cut their position size by almost half. And as you said, Ren, they've now got this cash pile, which is mainly invested in short-term treasuries, which is now $276.9 billion.
Wow. Yeah. So they sold half their Apple stock. Now, for people who are worried, who own Apple and are thinking should they sell as well, they sold 390 million Apple shares. They still own 400 million Apple shares. So, don't panic too much. But they also sold Bank of America. They sold a couple of other companies. They sold $75.5 billion worth of stock in the quarter. And so I had people wondering what's going on here. Is Buffett making a prediction about the movement of the market? If he was, he nailed it. But he doesn't normally play a short-term market game. People were asking, is he gearing up for a massive acquisition? People were asking, has he lost faith in the US economy? Has he lost faith in Apple? It's all speculation. We don't know.
Lots of questions.
There is also a simpler explanation, which is in 2016, he was buying Apple at a PE of between 12 and 18. Apple now trades at a PE of 34.
Was it between 12 and 18?
Apple was cheap.
God.
Yeah. So, there's perhaps a simpler explanation, but Buffett has $250 billion.
What's he going to... So, Ren, you've been teeing this up in office for a while, that you have a theory about why Buffett is getting this cash, what his succession planning may look like. So you haven't told me all the details, so I think now's the time to disclose. What do you think's happening here?
All right, so I have a theory that I haven't seen discussed anywhere, and maybe it's too extreme, but I reckon it's quite elegant. So I want you to imagine you're Warren Buffett.
Okay.
93 years old. You're thinking about succession planning. Sadly, Charlie Munger has just died. And you have had loyal investors that have stayed the course with you since 1965. Generations, in some cases, of investors that you want to do right by as you move on. You own 16.5% of Berkshire. You're the largest shareholder. Now, normally when you're thinking about succession planning, you have two choices. The hereditary route, where you pass the shares onto your children, and then they take control of the business and obviously the wealth that goes with it, or a trust route, where you put shares in a trust and the trustee then sort of has the voting power, I guess, of the shares, and then the beneficiary can be different. You kind of split the control and the wealth somewhat. Maybe you put charity as a beneficiary, maybe your kids. It depends. But the problem with both of these options is for Buffett, is he's passing control to a new entity. And no one is going to be Buffett again. And I think they have a third quite elegant option, and it kind of looks like they're gearing up for it. Berkshire currently worth $938 billion, meaning Buffett's 16.5% is worth $155 billion. Berkshire could do history's largest stock buyback.
Okay.
So they take their cash pile and they spend $155 billion buying all of Buffett's shares back. Now, why is this elegant and why does it make sense? First of all, it's a way to return Buffett's wealth to all shareholders that have been with him on the journey, because every Berkshire shareholder then owns a meaningful amount more of the company. Secondly, he said he wants to donate 99% of his wealth to charity. But it's difficult if you donate shares to charity, because then if they all try and sell them, then you tank the stock price. Not good for those loyal shareholders. But doing a buyback means you separate the shares from the wealth, and he can just donate his money to charity rather than the shares. Thirdly, it makes sense for Berkshire. Now, Berkshire is currently stuck. It's so big that they're struggling to find an acquisition that moves the needle, that makes a difference for their business. And anything they try and buy is going to run into antitrust scrutiny. This is a way to use that capital, return money to shareholders, add value without running into these problems that they're currently facing. And finally, it would leave Berkshire with over $100 billion in capital on their balance sheet. Now, the one drawback of this strategy, Buffett would have a big capital gains tax bill. But, he's always one to say you shouldn't be worried about paying tax. And what a way for him to go out giving $40 billion to the US government.
Yeah. That was going to be my first question. What's the tax implications for Buffett? You've answered that. It makes sense when you say it like that. So just help me understand this a bit better. What would the impact on current shareholders practically be? Like, how would it work? What do you think it would happen to the price?
It would be massively beneficial to the shareholders, because like the concept of buybacks is if a company has 10 shares, each shareholder owns 10% of the company. If the company buys back 2 shares and destroys them, there's 8 shares left. Each shareholder now owns 12.5% of the company. So Berkshire would essentially buy Buffett's shares, destroy them, and every shareholder's remaining share would be a larger percentage of the company.
Would there be any fear that they don't know what to do with money anymore, or is that fear already there? Do you think?
Who?
Berkshire, in terms of why they're not buying companies with this cash rather than just buying the shares back? I want them to grow this cash for me.
Well, as I said, it's hard for them to find something to buy.
And Buffett's openly said that now, hasn't he?
And because they're almost $1 trillion company, like they're going to run into antitrust scrutiny. They already control so much of the energy sector, of the railway sector, of all these sectors that they're big in, that they would struggle to buy something that moves the needle.
Yeah. And we've never seen anything on Berkshire's scale before, but have we seen any exits like this before that you can think of in history?
Not that I'm aware of.
No.
Yeah.
Okay.
Yeah.
And obviously not financial advice, but as you say, if this thesis was to play out, you'd see quite a strong appreciation in the Berkshire share price. So is it something how strong are you on this?
I mean, I haven't acted on it. It's just a theory, but I think I'd be interested to know what people think. Hit us up on equitymates.com/contact, because it's just a theory, but it's my best guess at why they're just amassing so much cash.
It's a lot of cash.
Yeah.
They've got to do something with it.
Yeah. Anyway, I think let's leave it there before we go too far down the rabbit hole and I start throwing out some other theories. Simo, thank you for joining us today. It's been a massive couple of days in news, and I'm glad we jumped on and spoke about it.
Thank you.
If you've enjoyed this episode, make sure you subscribe to the Equity Mates podcast feed so you don't miss the next one. And if you want to keep up with the news, head over to our email and sign up to our daily news brief, a short, sharp summary of everything that's going on in the news. You can find the link to that in the show notes.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.